Gold is sitting at one of the most important institutional decision points on the chart right now. Smart money has already engineered the liquidity grab, and the next expansion move could trap thousands of retail traders. Let's dive in and try to track the footprints of smart money to understand the next move. In this breakdown, we're going to analyze gold exactly like institutional traders do, using market structure, liquidity theory, and pure price action. No indicators, no guessing, just smart money concepts. Starting with the 1-hour time frame, the overall structure is clearly bearish. Price continues printing lower highs and lower lows, showing sustained institutional selling pressure. Every bearish break of structure confirms continuation. Notice how price keeps violating previous lows aggressively while bullish pullbacks remain weak and temporary. These red zones represent institutional supply areas. Every time price retraces into these regions, sellers immediately absorb buying pressure. That strong high above current price is a major liquidity magnet. Institutions know retail breakout traders place stop losses and buy orders around these highs. Notice how price wicked into supply and immediately collapsed. That's not random selling. That's institutional distribution entering the market with size. The change of character near 4,640 was the first warning sign that bullish momentum was fading. Smart money shifted narrative before retail traders even noticed. Below current price, we can clearly see weak lows and clustered liquidity. These levels become targets because institutions need liquidity to fill large positions. Before the major drop, price spent hours consolidating. This is classic accumulation of liquidity before institutional expansion. The impulsive sell-off tells us one thing: institutions are still in control. Momentum candles remain aggressive while bullish recoveries lack conviction. Now price is slowing down near the current demand area. But slowing momentum does not automatically mean reversal. Often, this becomes another manipulation phase. These equal lows are extremely important. Retail traders see support, institutions see liquidity waiting to be harvested. Most retail traders place stop losses directly below obvious lows. Smart money uses this predictable behavior to engineer liquidity sweeps. Notice the imbalance between selling pressure and buying response. Sellers remain dominant while buyers only create temporary reactions. If bearish momentum continues, the most probable path is a sweep into the weak lows near 4,480 before any meaningful bullish expansion. The institutional narrative is simple: distribute at premium zones, manipulate during consolidation, then expand into liquidity resting below. This demand zone is currently preventing immediate continuation lower. But if price starts accepting below it, bearish continuation becomes highly likely. Smaller candles and overlapping structure indicate absorption. Institutions may be preparing either a liquidity sweep lower or a short-term reversal. Now let's move to the 15-minute time frame, where we can study the execution behavior and uncover what smart money is doing right now. On the 15-minute time frame, price is clearly consolidating after the major sell-off. This tells us the market is searching for liquidity before the next expansion. These equal lows are becoming more obvious on the lower time frame. The more obvious liquidity becomes, the more attractive it is for institutions. We can also see a small internal bullish structure forming. But until higher time frame supply breaks, this remains counter-trend movement. Every bullish push is being rejected quickly. That tells us sellers are still active and absorbing buy-side pressure aggressively. Retail traders often mistake these small breakouts for reversals. Institutions use those breakout entries as liquidity for larger sell positions. Right now, price continues reacting from demand. But notice the lack of explosive bullish continuation. That weakness matters. If price breaks below this consolidation cleanly, the market could accelerate rapidly toward the weak lows and deeper liquidity. However, if institutions engineer a sweep below equal lows and reclaim the range aggressively, a short squeeze higher becomes possible. This is where patience becomes critical. Smart money traders don't predict. They react to confirmation after liquidity events. Let's start with the high probability sell setup aligned with the higher time frame bearish narrative. The ideal sell entry comes after a liquidity sweep into 4,565 to 4,580, followed by bearish rejection and lower time frame confirmation. Stop loss should remain above 4,605 to protect against deeper manipulation. First target sits at 4,520 with extended targets near 4,485. This setup works because institutions often sweep short-term highs to trap breakout buyers before reversing aggressively lower. Never enter blindly. Wait for momentum confirmation, ideally a bearish engulfing candle or a break of internal bullish structure. So the bearish execution plan is simple: sweep liquidity, reject supply, confirm weakness, then target liquidity resting below. Now let's discuss the bullish scenario, but remember, this is counter trend until higher time frame structure shifts. The ideal buy setup requires a sell side liquidity sweep below the equal lows followed by aggressive reclaim into demand. Buy entry becomes valid around 4,510 to 4,520 after strong bullish displacement confirms institutional absorption. Stop loss should remain below 4,480 because acceptance below weak lows invalidates the bullish thesis completely. This reversal setup works when institutions trap late sellers below support, then force recovering through aggressive upside expansion. Professional traders focus on liquidity first, direction second. Liquidity tells you where institutions need price to travel. Most explosive moves begin from consolidation. Compression is not random, it's preparation for expansion. The highest probability trades happen when higher time frame bias aligns with lower time frame confirmation. So right now, gold remains inside a critical institutional zone. Liquidity sits above and below price, and the next expansion move could be explosive. If you want more professional smart money breakdowns like this, subscribe now and stay ahead of retail psychology. The market leaves clues if you know how to read them.